If your home is worth £2 million or more, there's a new annual bill heading your way, and it has nothing to do with your local council. I'm Angela Rose, and today I'm explaining the new high-value council tax surcharge, who it actually affects, how much it costs, and what homeowners should be doing right now to prepare, even though it doesn't start for another couple of years. Hi everyone, welcome back. I'm Angela Rose, and this channel is where I break down financial and property news in clear, honest language, without the jargon. Today's topic has been dubbed the mansion tax in the press, but its official name is the high-value council tax surcharge. It was announced by the Chancellor in the autumn budget on the 26th of November, 2025, and it's set to apply to residential properties in England valued at £2 million or more. While the surcharge itself doesn't actually start being collected until April 2028, the valuations that determine who's affected are based on property values as of 2026. Which means this matters right now for anyone who owns a high-value home. By the end of this video, you'll understand exactly how this surcharge works, how much it costs, who's genuinely likely to be caught by it, and what steps are worth taking now while a government consultation on the finer details is still underway. Let's start with the basic mechanics, because there's a lot of confusion around how this differs from ordinary council tax. The high-value council tax surcharge is a new annual charge on residential properties in England, valued at £2 million or more, based on 2026 valuations. It will be collected alongside your existing council tax bill, starting from April 2028. But unlike ordinary council tax, this money doesn't go to your local authority. It goes directly to the Treasury. The charge operates on a sliding scale based on 4 value bands. Properties valued between £2 million and £2.5 million face a charge of £2,500 a year. Properties between £2.5 million and £3.5 million face £3,500 a year. Between £3.5 million and £5 million, it rises to £5,000 a year. And anything valued above £5 million faces the top rate of £7,500 a year. From the 2029 to 2030 tax year onward, these amounts are set to increase annually in line with inflation. One detail that trips a lot of people up. This surcharge is charged to the property owner, not the occupier. So if you're renting a high-value home, you personally won't pay this. Your landlord will, whether or not they actually live in the property themselves. This applies whether the property in question is somebody's main home, a second home, or a rental investment. This is genuinely one of the trickiest parts of the whole policy, so let's slow down here. To determine which properties fall into scope, the Valuation Office agency will carry out what the Treasury has described as a targeted valuation exercise, using property values as they stood in 2026. According to reporting on the policy, the vast majority of these valuations are expected to be desk-based, rather than involving a physical inspection of every property, though in-person inspections may happen where a property lacks sufficient comparable sales data to assess accurately. Revaluations are expected to take place every 5 years going forward. Now, how many homes are we actually talking about? According to the government's own figures, fewer than 1% of properties in England are expected to fall above the £2 million threshold. The Independent Office for Budget Responsibility estimates that, once behavioral effects are factored in, roughly 156,000 properties will be subject to the surcharge in its first year, rising slightly to around 158,000 by 2030 and 2031. The government expects this to raise approximately £400 to £430 million a year in revenue once fully in effect. Where are these homes concentrated? Overwhelmingly in London and the Southeast. Based on recent property sales data, London alone accounts for the majority of homes sold at £2 million or more, and when you include the wider Southeast, that region accounts for the vast majority of high-value property sales across England. So while this is a national policy, its real-world impact is heavily concentrated in specific, higher-cost parts of the country. It's also worth being precise about geography here. This surcharge, as currently designed, applies specifically to properties in England. If you're in Scotland, Wales, or Northern Ireland, this particular policy doesn't apply to your council tax arrangements, since those nations have their own separate systems. Let's talk about what's confirmed law versus what's still being worked out, because this is an area where I want to be especially careful. The core policy, the £2 million threshold, the banded charges, and the April 2028 start date was confirmed in the autumn budget and has moved forward from there. However, a government consultation on the finer operational details closed on the 14th of July, 2026. Based on the information currently available, this consultation covered exactly how valuations will be challenged, how the scheme will handle edge cases, and reportedly whether an additional premium might apply to non-resident owners. Final detailed rules following that consultation haven't yet been published as of this recording, so some of the finer print is still being settled. So what should you actually do if you own, or think you might own, a property near or above this threshold? First, and this is my honest personal recommendation, not official advice, get a realistic sense of what your property is likely worth under a 2026 valuation. If you're close to the £2 million line, it's worth understanding roughly where you sit, since that will determine whether you're affected at all. Second, if you believe your property might be incorrectly valued once official figures are eventually issued, it may be worth appointing your own independent valuation surveyor ahead of time, so you have your own professional assessment ready to challenge an official valuation if you think it's inaccurate. Third, keep an eye on the outcome of that consultation and any further guidance published by HMRC and the Valuation Office agency, since the exact mechanics of billing, challenges, and exemptions are still being finalized. I'll continue covering this here as those details are confirmed. And finally, if this genuinely affects your household, this is exactly the kind of decision worth discussing with a financial advisor or property tax specialist, particularly if you're weighing decisions like whether to sell before the valuation date or restructure ownership of a high-value property. Let me step out of reporter mode for a moment and give you my honest take. In my opinion, this policy is fairly narrowly targeted, and I think that's worth acknowledging clearly. Affecting fewer than 1% of properties nationally is a genuinely small slice of homeowners, even if the financial impact on those specific households is real and, for some, substantial. I understand the government's stated reasoning around addressing wealth inequality tied to property values, and reasonable people will land differently on whether that's the right approach. That's a matter of political opinion, not something I'll tell you how to feel about. What I will say plainly is this: if you're anywhere near that £2 million threshold, don't wait until 2028 to think about this. The valuation date is already effectively locked in at 2026, so the window to understand your position and plan accordingly is now, not 2 years from now when the bills actually start arriving. Quick recap before we wrap up. The high-value council tax surcharge, confirmed in the Autumn Budget 2025, will apply to residential properties in England valued at £2 million or more, based on 2026 valuations. Charges range from £2,500 to £7,500 a year depending on the property's value band, starting from April 2028, and are paid by the owner, not the occupier. Fewer than 1% of English properties are expected to be affected, concentrated heavily in London and the South East. Some finer operational details are still being finalized following a consultation that closed in July 2026. If you own a high-value property or think you might be near the threshold, this is genuinely worth looking into now. That's today's update. I hope this gave you a clear, accurate picture of a policy that's generated a lot of headlines, but not always a lot of clarity. As always, for decisions specific to your own property and finances, please speak with a regulated financial advisor or property tax specialist, and check official guidance from HMRC and the Valuation Office agency as it's published. If this video helped you, please hit that like button. It genuinely helps this channel reach more people trying to understand what this actually means for them. Subscribe and turn on notifications too, since I'll be covering the final rules as they're confirmed. Let me know in the comments, do you think this surcharge is a fair approach, or should it work differently? I read every comment, so let's talk about it down there. Thank you so much for watching. I'm Angela Rose, and I'll see you in the next one.